All right, welcome to the Daily Deal List. I love this set of three properties we sent out this morning. The first one, I'm going to share my screen here so y'all can see, is a 20 unit complex in Hillsboro, Texas, that recently had about I believe it was almost a $200,000 price drop. So what you're looking at, this thing was originally posted for 1,600,000. It was dropped all the way down to 1.4, and I like it at this number because it had multiple contracts at 1.6. There were, I think, two contracts that started and then failed for various reasons. What you'll find is that these things are incredibly difficult to finance. I also think that it's probably not in the best of shape. Like if you just look at the description or the pictures, you could see the units are dated, even though it says it's fully updated and like rent ready. All of the listings say that, and none of them ever are. But I do think that this one, now at 1,400,000, given the current rent roll, is super interesting, which is why I included it. So check this out. Asking is 1,400,000. I think you could probably really squeeze this one down further, but even at the as is numbers, you're still looking at an 8 cap and a 10% cash on cash return. And for anything in any kind of proximity to a major metro in Texas, that's really interesting to me. I love that the 20 units market rate. We ran all of the comps. Market rate right now, they averaged the annualized income on it was about 725. So I think if you look at this, yeah, the T12 that we pulled had $174,000 in revenue. That equates to about $726 per unit on average. That doesn't, of course, take into account vacancy. So that's not a per occupied unit average. What you'll find is that these are going to lease up right around 825 per door. I think you can make an argument for market rate being closer to $900 per door, but then you start looking at higher vacancy rates. And I'd rather have a fully occupied unit. I'd rather have my pick of the litter when it comes to tenants. So I tend to always lease out a little bit on the lower side. So if market rate says we can charge up to 9, I would probably do something closer to 800 and make sure that my numbers are still cash flow positive, even using a more conservative leasing rate, which you can see here, $16,000 in a conservative monthly income number on 1,000,000 for purchase price is exceptional, especially anything within any kind of proximity to the DFW Metroplex. You can see we have insurance, taxes, vacancy, a management fee, utility costs. Even though utilities are billed back to tenants, you're still going to have common area utilities. You're still going to have utilities that you have to pay for because you have a vacancy or a move out. And you can see that we're still generating a nice cash on cash and cap rate from a mid 80s build. So I love it because we have a nice walk-in equity position. I really like it because we have a proven trailing 12-month revenue. I really like it because we have opportunity to increase that gross monthly income number. Red flags that we're looking at on this one. One, Hillsboro is it's not a big market. It's not a huge major metropolitan area. It's about an hour south of Fort Worth. But their claim to fame right now, I think they're building the largest Buc-ee's in Texas or maybe the world. But that's like really their claim to fame. And when you look at it on a map, I'll pull up a map so y'all can see. When you look at it on a map, it's right at the intersection of I-35 east and west. It's where it splits and it converges and it goes into either side of the Dallas-Fort Worth Metroplex. So it is an interesting corridor for growth. And I think you'll have a ton of transient traffic that goes through Hillsboro. But it's just not it's not like a major economic hub. So that's a red flag in terms of a deal like this. You're really buying it for the cash flow. I think you'll see modest year over year appreciation if you're holding it for a long enough period of time. Another major risk with this product is, even though I think it's a green flag that had been under contract for 1,600,000 twice. I think that's also, it could be looked at as a red flag. I think what you'll find is, one, financing on this is going to be incredibly difficult to secure. And two, I think when you really get into the nuts and bolts of this thing and you start doing an inspection, you're going to see a lot of stuff flagged. All of these reports, they come back and they're insane how detailed they are. Every single deficiency in the drywall, every single receptacle with reverse polarity is going to be flagged. And I'll bet if you were to do a detailed inspection on this, like you would do for a single family home, it would be 600 pages long. It's very, very difficult to have a buyer move forward on something like this if they're not used to seeing those inspection reports. So if it's a less sophisticated buyer, somebody who's buying it just because the on paper returns look solid, I could see an inspection scaring off a buyer. I could also see financing issues scaring off a buyer. Usually there's some sort of balloon payment involved. Maybe it's a DSCR product that needs to have that is going to be at a much higher interest rate, maybe 1.5 to 2% above what you would pay for a conventional rate. So that'll be your major red flag with this one. So why the Hillsboro market? What's the bull case for this little tiny pocket? Really, your bull case on this is going to be because you can get into something that has $16,000 a month in income for $1,000,000 purchase price, maybe $1,300,000 or whatever you can negotiate it down to. But you don't get those types of ratios in any other like major market. You can get down in here into the clean area and you can find those types of ratios. It's interesting that we're in Hillsboro, which does have more influence by the DFW Metroplex. It's interesting that we're in Hillsboro and still seeing that type of ratio. So proximity to DFW, the fact that it's this convergence between 35 West and East is interesting to me. So I think that there's a little bit of a bull case there in terms of the market, but we're really not buying this specifically because of the community of Hillsboro. The biggest risk on this one to a new investor, easily the biggest risk for a new investor, is looking at this as an on paper buy and saying, oh my gosh, look at that. I've been looking for an 8 cap. I've been looking for a 10% cash on cash return, but I just haven't been able to find it. I haven't been able to secure it. And then they see the on paper returns. It mirrors with what the revenue shows on the trailing 12-month revenue statement. All looks good on paper. And then realistically, executing a deal like this can be hyper challenging because you've got multiple different tenants, of course, who you're dealing with. You've got a smaller sub market, so you're not going to be able to go into like Google and find the right kind of plumber or the electrician. You really need to actually kind of get onto the ground, get into the local Facebook groups, and figure out who the players are who are going to be able to support the transaction. So I think key risk for a new investor in this type of asset is going to be building out a deep and reputable team. So there might be 2, maybe 3 good property managers who can cover the Hillsboro market. And if you're relying on that PM and they fail to deliver because they have extended vacancy, or maybe they're not getting the rents, or maybe they're not communicative enough, maybe now you're down to only a single other option. And I think those elements make this a very difficult property for a new operator who doesn't really have experience dealing with other trades, doesn't have experience in property management, doesn't have experience working with and for tenants, because that's what you're doing as a PM. You are really working for that tenant, and you're in a customer service centric business. I think that's a major issue for a first time investor buying into a property like this. Last piece here, final verdict. Good, bad, indifferent on this one. I think it's great for a specific type of buyer. Usually the type of buyer who's already done a duplex, they've already done a quad, they already house hacked a deal, maybe they have an Airbnb, and now it's like, okay, what's next? I've already gone through, I've gotten some bumps and bruises. I've been through the rigmarole with different types of financing strategies. I'm ready to level up my game. And this one seems like it has all of the elements to make a really successful deal if it's executed properly. This is a deal for an operator. This is a deal for somebody who can come in. They can say, I see all of these rents at $760, and there's one at $810, and I see another one at $690,000. I see that they had 3 months where it was only 80% occupied. It took them a couple months to fill that. They can go in with an executed marketing strategy. They can bring rents up to fair market value. They can be hyper diligent in terms of how they're renovating and spending CapEx dollars in order to really target repairs that are going to drive ROI without costing like retail. So you've got to go into the market. You've got to negotiate with contractors and vendors. This is a hands-on operator's deal. If you're that type of operator, I think this one is awesome. I think you'll be able to go ahead and stabilize the product and refinance out and be really happy and make a really successful deal of this one. So Let's go on to deal number two. What are we moving through here? We've got Austin. Austin is always an interesting one for us because it's so rare where we find something in Austin and it actually pencils and it's actually in a decent location and it's in good condition, all of the things that we look for. So, high level, it's an Airbnb property, $11,000 a month in reported income. I asked for the Airbnb statements earlier today. I haven't seen them yet. We have done a deal with this seller in the past, so I'll bet it's probably accurate. Maybe what I've seen on these ones, if they're not accurate, it's because maybe they had 1 month where they actually did 11,000, and they had a whole bunch of other months where it was like 8,000 or 6,500 or 9,000. Like they were getting close, but 11,000 was like representative of their best month. I don't think that's the case here. I do think that a duplex in Gracie Farms could easily pull $5,000 to $6,000 a month on average. We've seen that before. So I think that this one could be very, very similar. So let's see what we got. Deal breakdown wise, $600,000. Supposedly there's multiple offers. I don't think it's going to go below 595. I really don't. This thing just posted. I don't think it's going to go below 595 because they have the revenue statements. Supposedly, I haven't seen them yet, but supposedly they're coming. And a something where you can find $11,000 a month in revenue coming in, selling for under 600,000 is a kind of ridiculous multiple. I think that's like, I think it's like a 20% gross margin on this thing. So that's nuts. It's usually once you hit above 15%, they start to move pretty fast. If this one's a legit 20% margin, then that'll sell like crazy. So hopefully we get some confirmation on that and we can finalize a couple of these offers that I've got pending. We sent it out on the deal list this morning. If you subscribe to the deal list, victorstefan.com/daily-deals, you'll go ahead and get first access to all of these things that I post. But I do think this thing's going to sell pretty quick just because it's Austin and because of the revenue potential. Biggest red flag on this one. First, with a short-term rental in Austin, Austin has some pretty restrictive covenants around Airbnb. This one is reported as having short-term rental approval. I don't know if it's across all of the units. I haven't seen the permit, whether it's type 1 versus type 2 and what that would look like. That's going to be a risk for a new operator to take on. And also, a lot of these short-term rentals, the permits, they don't convey unless you're going to maintain the current management company. The short-term rental permit almost never conveys. So STR licensing in Austin is going to be a major risk. Another major risk, not really a huge one, but it's a risk, is going to be the actual income. Was it really accelerated due to a certain one-off event? I don't think so. Just because all of the Airbnb revenue that we've seen was actually a lot lower in 2025 as compared to 2024. So if we see a T12 and it really is pulling in $11,000 a month on average, I think that's a major green flag and we're going to move forward. But it is a risk nonetheless. Of course, buying an Airbnb, your income is highly variable, highly cyclical, highly tied to what's going on in like the macro economy and what that specific city has going on. Like our Airbnbs in Houston and DFW are going through the roof for 2026 because of World Cup. Austin doesn't have a giant name brand thing going on, not to the same scale as FIFA coming to Dallas. So I think if this does show 11,000 a month and we can prove the month over month revenue was legit, I think it'll go pretty quick. But that would be a minor flag. The biggest flag with this one is definitely going to be permitting in the Austin market. Austin gives you some pretty good exposure to the tech industry. It's definitely our most tech forward market out of all of the cities that we cover: Dallas, Fort Worth, Austin, San Antonio, and Houston. Austin, of course, has the most vibrant tech scene, and this one being on the north side of town is going to be very close to the Domain, to the Arboretum. It's going to be close to the Dell campus, the Apple campus. A lot of the major tech corridor around Tech Ridge. This is going to be a nice pocket for that. So I do think that there's opportunity to have exposure to Austin's tech scene by investing into a deal like this. I do think that people who are investing into Austin are typically more interested in the appreciation of the asset. And the fact that this one can show on paper $11,000 a month income, and you can show a reasonable path to have this type of cash on cash return on an Austin property is a major bull case. And if you're looking for more appreciation centric assets, this is definitely one to consider. Biggest risk, like I kind of mentioned before, or biggest risk for a new investor, rather, is just going to be navigating the permitting process. Also, there's some element of um, operator bias because you could have an Airbnb that's performing at, let's say, the 80th or the 90th percentile in terms of performance, and it could be doing $100,000 a year. Whereas a median Airbnb, something at the 50th percentile, maybe that thing is only doing $75,000 annually. And then you can have a lower tiered operator that's pulling in $55,000 to $60,000 a year. So if this is a professional operator, which looking at the Airbnb posting and the reviews, it does seem like they're a relatively skilled operator. So I bet this is performing at like the 85 to 95th percentile of what this exact asset type could perform at. A new operator coming in with no Airbnb experience obviously is not going to perform at the same level. Whereas you could also have somebody come into this thing who is an experienced and proficient Airbnb operator, and they do have a little bit of cash to do the certain things that do drive revenue and that can increase this property. And you can push this number from, let's say, 100 or $132,000 annually. That could get up to 140 for the right operator. But it could also fall to $65,000 if you don't know what the heck you're doing and you just post this on Airbnb and you set a static pricing target and you never doctor it. You never follow up with your guests. And you don't keep a fresh and active perspective on your profile. And then they're calling me in 6 months asking me to sell it. So I think major risk for a new operator is just expecting, if you've never ran an Airbnb before, that you're going to be able to repeat these same values. But worst case scenario, you do see that it's possible. You do see that it was proven, and now you can copy and paste the previous owner's operating manual. That would be the best case or the best course of action for a new operator trying to get into the Airbnb business, because that risk exists for everybody who's buying their first Airbnb. It's not just like this one. That's going to be the story for anybody who's doing their first Airbnb. It can't be expected that you're going to be a 99th percentile operator, but you can take a successful Airbnb and you can copy and paste that model. So I think that's interesting. Final verdict on this one. If it's legit $11,000 in 2025 revenue, that's insane. This is a major one to jump on. And the fact that it's in the 78758, access to the tech corridor, priced at 600,000, when realistically, if it's doing $130,000 a year, what's 6 times 130,000? I'm going to do it. I'm not going to do math in public unless I'm using a calculator. Yeah. So if it was $130,000 in actual revenue, your break even is somewhere in the realm of $750 to $775,000. Would be like your, yeah, it's okay, but let's skip it. There's going to be better ones. $600,000 is an exceptional entry for that level of revenue if it's legit and can be proven. Time will tell. Last one on the list for today. Spring, Texas. Here we go. So this one on Twain Street does have proven revenue. It's another Airbnb. It's another one that I like just because I like looking for these opportunities where you do have high income, you do have a turnkey asset, you can finance effectively the entire Airbnb operation. It's like a business in a box. This one is going to be a lot lower of a price point. And what you'll find is, even though the ratios are the same, let's say you have a property that's selling for 5.5 times proven trailing 12 months revenue. That property that is selling for $800,000 is actually going to have a lot higher cash on cash return than that property like this one that's selling for $360,000, because there are fixed costs with running these Airbnbs. So I like to look for Airbnbs that are on a little bit of the higher side, something like say 7 to $800,000. But there's a huge subsect of people who are looking for these lower end, not lower end, but like these lower cost Airbnb properties. And this would be a great option for that type of investor, somebody who's looking for something in the mid 300s. And it's totally set up, ready to go. They've already got their hot tub in place. They've already got all the Airbnb isms, the foosball tables and the backyard space and ping pong, and they're all set up. They're ready to go. So this is a decent Airbnb in the spring market. And what's cool about this one is it's priced appropriately as if it was a retail sale. A lot of times when you see a turnkey Airbnb asset, they'll be priced, say, $50,000 to $75,000 above FMV, above fair market value. This one is priced exactly where it should be. Like if you're going to go get an appraisal, it's going to appraise at $350,000 to $360,000. So that's interesting. You're effectively getting the operations part of the business and furnishings totally for free. So the biggest red flag on this one that I would point to right here, obviously, 1966 build on an asset that you're going to try and manage from either overseas or out of state, like most of our clients, that's going to be a tough one. Just because it's older, it's going to have more CapEx. And I think that's going to be something that a newer operator might have a lot of issues with. The spring market, we've seen a lot of people get into the spring market just because of asset and neighborhood qualities. Also because there's proximity to the woodlands. The woodlands have been really interesting for a lot of our overseas out-of-state clients, but just for the appreciation and potential of that product. Final verdict, is this one that we're going to move forward on? Is this one that we would have a new investor buy? Actually, yes, especially if somebody's local to the woodlands or they're local to spring. And they want something that they could use to offset W-2 income via the STR loophole. This could be a great option for that type of buyer. I would be a little hesitant for somebody who's looking to set it and forget it and have a management company take this thing over just because it's a 1966 build. I think that ultimately, at the end of the day, a local owner operator buying into their first Airbnb in the Houston market would do really well with this type of product. They would have a great launch pad to move their business forward on because everything is already set up and it's all going to be financed right into this $350,000 strike price. So that's your deal list for today. Let me go ahead and stop sharing my screen if I could figure out how to do it. And every single day, every business day, Monday to Friday, I'm posting this deal list. There's always going to be 3, sometimes 4, maybe 5 deals that are posted. Most of the time, they're going to be off-market opportunities, and they go out every single Monday, Tuesday, Wednesday, Thursday, Friday. If you want to get first dibs at these things, you have to subscribe to the deal list, victorsteffen.com/daily-deals, and we cannot wait to work with you. We'll see you later.